A lot of this I'll be talking with a broad brush about lenders in the industry who offer home equity loans and lines of credit, but just know this, that this is an overview of the basics, but every lender typically tweaks what it is that they do to make this their own so that you're borrowing with them. So there's a lot of little nuances that I couldn't begin to guess what others are doing. I'm the Vice President of Lending at the credit union, and so I can certainly tell you about what our products look like, but I want to start with the broad brush because that's up to you and what your needs specifically are so that you pick the lender that works best for what your needs are. But what is home equity? Basically, home equity is the amount of the house that you live in that you actually own. So your equity is the value of your house at any given time minus what you owe on it. The rest is yours. So in the little example on the slide, if your house is worth $500,000 and you have a mortgage currently on it of $2, you have $300,000 in equity. That's your value of that house. That's all yours. And of course, there are many lenders who are very happy to give you a loan based on the equity you've built in your house. Because if anyone was unsure, home equity loans and lines of credit are a mortgage and there's a lien put on your house. So the lender is fully secured. So it is a mortgage. A lot of people don't call it a mortgage, and that can lead to a confusion, but a mortgage is typically just a lien on your property, if you think of it that way. So home equities are typically a second mortgage on your house. Some places will call it a second mortgage, some places will call it home equity loans or lines of credit, but it's usually a second mortgage. If you have no first, there are lenders who will still call it a second mortgage because this mortgage isn't used to purchase. 80% of the value of your home, we're going to go over this a little bit more in general or a little bit more in depth on the next slide, but a couple of points I want to make out. This is generally what lenders do. There are a few lenders that will only go up to 70%. There are lenders that will go up to 90 or more because it's a more riskier loan, though you may pay more when you do an equity line or loan of more than 80%, but there are places that offer. Credit union offers that other product too. But the thing I want to note on the slide, and we'll look at this in the next slide, is that lenders are lending up to 80% of the value of your house, not 80% of your equity. So we're going to do an example on how that calculates into what you actually get as far as a loan amount. So in order to calculate the equity available to borrow against, we're going to take the value of your home and we're going to multiply that by 80% and then subtract off the first mortgage amount. In this example, we're starting with the value of the home as $250,000 and we're doing 80% of that. 80% of the value of your home, not the value of your equity, 80% of the value of your home in this example is $200,000. And in this example, there's a mortgage of $150,000. So the amount available for you to borrow against is $50,000. The way lenders determine values is we look at homes that have sold that are similar to your house within the last 6 months and compare. There are places out there that you could go look. You can go look at Zillow. You can go look at Trulia. I think Realtor.com, if you put your address, will give you what are called comps. What are comparable sales, but they're only updated, I don't know how often they're updated, let's put it that way. Lenders actually purchase a program or software or maybe use a third party that makes sure that these values or these home sales are up to date in their system constantly, like weekly, at the very least, sometimes daily. So your lender is purchasing a tool so that we make sure that we're affixing the best possible value to your home based on what's recently happened in your neighborhood. But know that that lender is going to use a system that's going to give them more precise data than you're going to get for free online. The other thing to keep in mind is if you do speak to a lender and the lender's willing to pull a value of your home and say, okay, based on what you've told me, based on where you live, this is what I have for a value, an automated value of your home. If you look at that and you really believe that your house is worth more, for whatever reason, we and most lenders will allow you to do an appraisal. The appraisal has to be ordered by the lender. I don't know of any lenders who are covering that charge because it's about $350, $400, depending on where you are and the type of house you have. But any lender is going to be happy to get an appraisal of your home because that's really the true value of your house on that particular day that somebody went out and looked and plugged in all the data that they had at their fingertips. So lenders are happy to use appraisals. If you've recently bought your home or refinanced your home at some other lender, and I'm speaking for the credit union now, and you have a copy of an appraisal that was done within the last year, I would say, we'd be happy to use that. It's still going to give you better information than what we're going to get on an automated value. Now, if the automated value comes in higher than your appraisal, then you really have to talk to your lender. I mean, so it depends. Sometimes people can be creative. We could do an average of the two. We could go to the highest. We could go to the lowest. Depends on lots of factors. But there's a lot of moving parts in home equity lending and borrowing. What is a home equity line of credit? Well, we're talking about home equity lines of credit and home equity loans staying on this slide. But a home equity line of credit, or a HELOC, is a line of credit based on the equity that you have built in your home, and it acts like a credit card or a line of credit whereby the lender is giving you a limit. And how much you borrow on that limit is up to you. You control how much you borrow and pay from month to month. Your interest is going to be based on how much you have borrowed the month previous. So we could give you a $300,000 line of credit, and if all of you used is $5,000, your payment is going to be based on that $5,000 limit, or that $5,000 balance. As the balance goes up and down, your payment adjusts. I'm going to go into more details, but if you look at that line of credit and compare that to home equity loan, which we're going to do in another slide, home equity loan is just what it says. It's one lump sum the day that you close. Here's your check for the whole amount. Here's your payment structure from now to when you're done, and terms are different. We'll compare a little bit more. I will say this though, that on both the home equity line and home equity loan, it's up to you how you want to spend that money. It's not like a car loan where we're making a check out to you, to the dealership, that you're buying this car and that's why we're giving you a rate. We're giving you a great rate because you're borrowing against your home. What you want to do with that is up to you. You take a trip around the world if you want to take a trip around the world, or you can put the money back into your house and refurbish it. It's up to you. When you're trying to make a decision on whether or not you want a line of credit or a loan, and generally the dollar amounts are the same, right? The amount available for you to borrow. But a line of credit is a variable rate product. Everywhere I've looked, a home equity line of credit is a variable rate of product. So your rate may change subject to whatever the index is, which the credit union uses prime lending rate. Most places use a prime lending rate. So if the Fed raises the prime rate, your rate is going to go up. If they lower your rate, your rate comes down. So it's a variable rate product, but you control how much you owe and how much you repay on that. Whereby the fixed equity, fixed second mortgage, is a fixed rate product where your rate is never going to change, and you know what your monthly payments are because you're going to pick, I want X amount of dollars and I want that to be 15 years, and here's what your payment is. That rate's not going to change, your payment's not going to change. It does with the line of credit. Things to consider with the line of credit: if you're not doing a big job around your house or having a big expenditure, the line of credit is nice because you're only paying on what you owe. The home equity loan is typically for somebody who has some idea in mind that they're going to need a lump sum of money, and here it all is. Because the rate on your home equity loan is going to be higher than what you can invest that extra money is if you don't have use of it, right? Or a need of it. So that's something that really differentiates the two products. And so this is a comparison. We talked about the rates, one being fixed and one being a variable rate. One thing we didn't talk about with the line of credit is that, And this is typical, but this is another thing, the term, this changes from lender to lender. So what I've quoted here is what the credit union offers, but it's pretty typical. So with the line of credit, we've set you up for a 10-year period in which you can draw on your line of credit, borrow and pay and borrow and pay. At the end of 10 years, if you have a balance, we structure that as now a fixed repayment term of 10 years to repay whatever you owe. You can't draw on it anymore, but whatever the balance is at the end, we could draw out over 10 years, or you can shorten that if you want, depending on what you have left. Still variable rate product though. The way the credit union has structured our payments, that first 10 years on the HELOC is we only charge you interest. So you could have a payment of less than $100, but if you want to pay $1,000, it just brings your line down more. You know, gives you more reestablished to borrow against, but we only charge you interest. So if all you're paying is interest, that balance can only go up and up and up for the first 10 years. And it doesn't come down unless you put money at it. But we feel that, you know, that's a friendly thing to do because you can always pay if you want to pay more. Other lenders may require you to pay some principal down every month. I've seen it be like 1%, I've seen it be 2%, but when you're talking hundreds of thousands of dollars, that can be a lot of a principal repayment. But we try and give you as much flexibility as we can. A lot of people after the first 10 years where they're coming to a close on their draw ask if they can reestablish a limit, and we just simply do a new application and review everything all over again, which will start another 10 years. The home equity loan, we said it's fixed rate. It's a one lump sum at the time that you close, and we typically do a 5-year, 10-year, 15, up to 20-year repayment. If you really said to us, you know, well, I want a payment of X amount of dollars, and we calculate that, and that's 13.5 years, we just fix your payment at what you want and let you go from there. I wanted to keep it short and simple, and we're done.